everybody, Happy New Year. Stephen Windsor here with Coldwell Banker, and welcome back to another episode of Afternoon Tea with me. So today I'd like to take a look back at 2020, ignore a lot of the drama and really dive into the data. When COVID-19 first hit and the whole nation went into lockdown, there were a lot of experts predicting what kind of recovery we would see, whether it would be a U shape or a V or an L. Today, I'd really like to take a look at what was predicted, what happened, and what kind of market conditions surround us currently, and how, when we move into 2021, what the projections and circumstances we'll find ourselves in. So when the pandemic first hit back in February, March of 2020, a lot of the country thought that we would see perhaps a substantial dip in house prices, and if not, a repeat of what we saw back in the late 2000s with the financial crash around 2007, 2008. Susie, our mom, was one of the first people to come out and predict a considerable drop in house prices, similar to what we saw from to a 50% drop in house prices. That's not what happened back in March of 2020. Mark Fleming was probably one of the closest to projecting that we would see quite a different trajectory in response to the COVID-19 outbreak. And then, in fact, it would be housing that would lead us out of this recession. Now, a recession doesn't always equal housing crisis. We can see that illustrated here in the previous 6 recessions. Only in 2008 and 1991 did we, in fact, see a dip of any kind. 2008 being such a dramatic drop, almost 20% in home prices nationwide, is probably why people correlate that back to that experience in the late 2000s. In 2020, we've actually seen an increase in house prices during this pandemic. 7.3% is quite high. Some of the factors that have fueled that is the classic supply and demand. The inventory levels have dropped so low, and that's illustrated here. You can see a steady decline since around 2011, with the peak there, 2010, 2011, all the way to 2020. We also see the exact opposite, with house prices coming all the way back to almost pre crash levels. So a few of those things that have been fueling that increase in activity has been the historically low interest rates that we've seen. I think we've broken records for the 14th time to a historically low interest rate. And that's also going to continue into 2021. The Federal Reserve announced several weeks back that they wouldn't be really intervening in that interest rate until they saw a considerable adjustment in the housing market. So we can expect interest rates to kind of bounce around that 3% mark for the next 12 months. This map really illustrates what kind of recovery we saw in the housing market based on supply, demand, price, and time on market. You can really see the V shape in this chart. Many had predicted a U, a Nike swoosh, but going back to February of 2021, when we really hit the brakes on the market, and there wasn't much activity until May, you can see a steady increase until the end of the year there, rebounding and going above where we were at in late February, early March. Now, if you take the annual house price appreciation rate and compound that Since 1991, we've seen a 3.8% increase, and since 2012, a 6.1% increase. If you take that historical appreciation and graph it over the actual rate, we see the ups and downs of the market. But if you just divide that up over a 20-year period, you'll see we're not far off where we're supposed to be right now, with the actual appreciation rate. The frenzy that we saw back in 2006, and this was written by Lawrence Yun, who's a chief economist with the National Association of Realtors, kind of points out a few of the factors that aren't apparent in this increase in prices. The main one, I believe, is that the inventory level and production levels. And what we saw 14 years ago, there was a 3.8 million homes listed for sale, and home builders were putting up about 2 million new units. Now, inventory is only about 1.5 million homes, and the home builders are underproducing relative to historical averages. That's not something we saw back in 2006, and the frenzy of adjustable rate mortgages and those occurrences are not present in this market. And I think that one of the main differences is the equity that people have in their home right now, and that they've built up over the past 10 or 15 years, that wasn't apparent back then. And also the amount of options that are on the table and are available to a homeowner today that perhaps is in need of help, and they're in forbearance, and heaven forbid that they can't find a way out. There's a lot more options that if you're looking to sell your home right now, you can expect a premium in this market. It's very much nationwide. We're seeing a seller's market at different price points. What home buyers are searching for today is a little different from perhaps 12 months ago. And when we see that change come back, we don't know. But right now, and please feel free to reach out to me directly if you are having any issues. Please let me know, and we can kind of go over from forbearance to rent relief to even listing your home, and how we resolve some of those issues for you. This just a quick picture of what these big institutions are forecasting for 2021. Positive from all angles for you. If you're looking to purchase, you can lock in some of those incredibly low interest rates right now and amortize that over 30 years. You'll be in it's much more affordable, even though we have seen an increase in home prices. You can take advantage of some of the low interest rates moving into 2021 is very positive. And also from a seller's perspective, if you're looking to move on right now, you have a lot of desire and qualified buyers looking to purchase your home. Yes, and then last of all, what we're seeing, seasonal trends that the COVID-19 pandemic has kind of thrown out the window. I think we can see a little bit more of a typical cycle, especially in our market down in Florida, with the vaccine coming out and people starting to look to plan ahead in 2021 and perhaps plan that trip down here to pick up that second vacation home. We're looking forward to seeing a little bit of normality, and now with a new administration coming in, if they continue to make on those promises of relief to markets, we can continue to see a little bit more stability, I believe. But thank you so much for joining me today, and I hope that was not too long of a slideshow for you, and I look forward to seeing you all next time. Thanks.